They told you AI was a software revolution. They told you the future was in the cloud. They were wrong. For years, the mainstream media and the giant investment banks have worked tirelessly to convince you that the digital economy existed in a vacuum, detached from the physical world. They wanted you to believe that the Magnificent Seven and the trillion-dollar tech giants were built on nothing but code and algorithms. But today, the curtain has been ripped back, and the reality is far more challenging for the global financial order. We are witnessing a desperate, cutthroat scramble for the one physical resource that makes the entire AI dream possible. And it isn't just chips, it's the metal that powers them. As of Sunday, December 28th, 2025, the global hierarchy has officially shifted. In a move that has sent shockwaves from the COMEX in New York to the heart of Silicon Valley, Nvidia has done the unthinkable. They did not just buy more compute power. They went directly for the hardware architecture's jugular. Nvidia has officially moved to secure the most efficient AI infrastructure on Earth, sealing a massive $20 billion strategic acquisition of Grok's assets that is being felt across every trading desk on the planet. I'm Kevin Huang, and this is Markets in Context. Before we break down the massive deal that has just rewired the silver-dependent tech market, make sure to subscribe to the channel and hit that notification bell. We are tracking a historic price discovery event that is currently liquidating the old financial guard, and you cannot afford to be behind the curve as the January 1st deadline approaches. Let's look at the hard evidence. As we sit here right now, the silver spot price is trading near $79.11 per troy ounce. Earlier this month, we hit an all-time high of $79.57. This is not just a rally, it is a total structural break. Silver has surged between 150% and 169.63% year to date, marking its single best annual performance since 1979. In the last month alone, silver has posted a staggering gain of over 48%. On December 26th, while most traders were away for the holidays, the metal jumped another 9%. The price containment mechanisms that the banks used for decades to manage this volatility have not just failed, they have been completely overwhelmed by industrial demand. But the real story is not the price, it is the strategic deal that confirmed the panic. Market reports have now confirmed that Nvidia has concluded a massive deal, valued at approximately $20 billion, to secure assets and licenses from Grok. While analysts are framing this as a play to dominate AI inference hardware, the deeper reality is far more urgent. Inference technology, the process of running AI models in real time, requires an immense amount of high conductivity hardware. This hardware is entirely dependent on silver's irreplaceable conductivity and durability. Nvidia is not just buying Grok, they are securing the hardware that will be the primary consumer of the remaining physical silver supply. The tech giants have realized that the paper markets are insufficient. For years, banks have traded digital contracts of silver they do not actually hold in reserve. But you cannot build an H100 GPU or an LPU inference server out of a paper contract. You need the metal. And as Nvidia enters the market with a $20 billion war chest, they are competing directly with the banks that are currently trapped in massive short positions. We are seeing a physical versus paper tension that has reached a breaking point. Reports confirm that the registered stocks at the COMEX, the actual metal available to satisfy contracts, have plummeted 70% since 2020. London vaults are down 40%. Following a historic demand surge in October, the paper-to-physical ratio has reached an unsustainable 356 to 1. This means that for every single physical ounce of silver sitting in a registered vault, there are 356 digital claims on it. This creates a mathematical risk for a total delivery bottleneck. Nvidia knows this, Samsung knows this, Elon Musk knows this. Musk himself recently broke his silence on X, warning that the silver shortage is not good for industrial processes. As the chief executive officer of Tesla and SpaceX, he is one of the largest industrial consumers of silver on the planet for electric vehicles and solar technology. His concern has acted as a validation signal for the entire market. The shortage is real, it is systemic, and it is accelerating. Now, let's talk about the China factor, which is the catalyst that is driving the current parabolic move. China is the world's dominant silver refiner, controlling between 60% and 70% of global capacity. And on January 1st, 2026, just 72 hours from now, they are pulling the plug. Beijing has announced a new regime of strict export controls. To get silver out of China after New Year's Day, an entity will need a special government license, must prove a production capacity of at least 80 tons, and hold credit lines of $30 million. This is a strategic move designed to keep the metal inside China for their own domestic AI and solar industries. This move is expected to remove roughly 13% of the total global silver supply from the international market overnight. The panic is already visible in the Shanghai premiums. On December 27th, physical silver in Shanghai reached a staggering $90.25 per ounce. That is a massive historic premium over the Western spot price. The market in Shanghai is in backwardation, meaning the spot price for immediate delivery is significantly higher than the futures price. Traders are paying $11 premiums just to get the metal into their hands now because they know that in 3 days, the export gates will be locked. The desperation of the Western financial system is starting to show. We are seeing unprecedented policy interventions that are normally reserved for total market collapses. The CME Group has just hiked margins for silver futures to a massive $25,000 per contract. Their intent is to crush the frenzy ahead of what traders are calling Silver Thursday. They are trying to force out the small speculators to protect the big clearinghouses from a total blow-up. But they are fighting against physics. Margin hikes only affect the paper traders. They do nothing to stop a company like Nvidia or Tesla from outbidding everyone for the physical metal. While the financial plumbing is bursting, the geopolitical map is being redrawn in real time, further fueling the safe haven demand. The United States Navy and Coast Guard are currently enforcing a total and complete blockade of Venezuelan oil tankers in the Caribbean. We have confirmed reports of the Navy actively seizing tankers like the Centuries and the Bella One in international waters. This escalation has heightened safe haven demand to critical levels as the commodity war intensifies. Simultaneously, the United States has conducted powerful and lethal airstrikes in Nigeria targeting ISIS militants. President Trump has signaled a return to direct military interventionism to protect strategic interests. When you combine these naval blockades and airstrikes with the high-profile assassination of a Russian general in Moscow on December 22nd, you have a perfect storm of systemic risk. Capital is fleeing digital assets and sovereign debt, moving toward the only assets that cannot be frozen or printed: physical gold and silver. Silver's year-to-date performance has now officially surpassed major tech benchmarks, ranking it as a premier global asset as of December 28th. This is the end of the software era dominance and the return of the physical era. In a world of naval blockades, resource nationalism, and AI hardware wars, the metal in your hand is worth more than the promise on your screen. But here is the detail that the mainstream analysts and the big bank talking heads are completely missing, and it is the reason why the industrial world is currently staring into the abyss. The era of thrifting is over. For years, engineers at companies like Tesla and Samsung have tried to reduce the amount of silver used in solar cells and electric vehicles to save on costs. But we have officially hit a wall of pure, unyielding physics. Silver is the most electrically conductive element in nature. Alternatives like copper simply do not have the same efficiency and are prone to oxidation, which ruins the lifespan of a multi-million-dollar solar array or an electric vehicle battery management system. In a world where energy efficiency is the only metric that matters, you cannot substitute silver without sacrificing the performance of the entire system. This makes the industrial demand inelastic. It means the giants like Nvidia, Samsung, and Apple will pay any price just to keep their assembly lines from stopping. This is precisely why Nvidia's $20 billion deal for Grok's assets is so critical. When the world's most advanced AI hardware company spends that kind of capital to dominate inference technology, they are not just buying code, they are securing the hardware capacity that consumes silver at a rate the market cannot sustain. Nvidia knows that in a conflict scenario where the Navy is seizing tankers and China is locking down exports, the only way to win is to own the physical supply chain before it vanishes. While the industrial side is panicking, the internal situation in China has reached a state of anti-involution. This is a massive strategic pivot where Beijing is forcing its solar and chip firms to stop the race to the bottom on prices and instead consolidate into giants that prioritize value and efficiency. This means they are moving away from cheap tech and toward high-efficiency technologies like TOPCon and heterojunction cells. The problem for the rest of the world, these high-efficiency systems require 50% more silver per panel than the older technology. China is effectively locking in a future where they consume more silver per unit of output than ever before, just as they are cutting off the rest of the world from their refining capacity. The internal panic in China is already manifesting in the financial markets. Look at the breaking news regarding the UBS SDIC Silver Futures Fund. Chinese authorities were forced to block new subscriptions to this fund today because retail investors were so desperate for silver exposure that they bid the fund up to a staggering 60% premium over the actual value of the underlying silver. Think about that. Chinese citizens are so concerned by the devaluation of the yuan and the shifts in their real estate market that they are willing to pay $1.60 for every $1 worth of silver exposure. This is a China syndrome, a market where demand is so aggressive it is breaking the very financial vehicles designed to contain it. And as the financial plumbing bursts, the geopolitical landscape is providing a tailwind of pure chaos. In Florida, President Zelensky is currently meeting with President Trump to present a 20-point peace plan. While the world hopes for a resolution, the market knows that the 10% of the plan that remains uncertain is where the danger lies. If these talks fail, we will see an immediate wave of risk aversion that will send the remaining liquid capital into hard assets. Combine this with the ongoing naval blockade in Venezuela, which United Nations experts have just condemned, and you have a world where the flow of resources is no longer governed by free trade, but by strategic force. The confirmation of United States air raids in Nigeria against ISIS further adds to the commodity war narrative. Nigeria is a key OPEC member and a vital part of the global energy and resource network. Intervention there, combined with the blockade in the Caribbean and the high-profile assassination of a Russian general in Moscow, paints a picture of a world where risk is no longer a tail event. It is the baseline. So where does this end? The psychology of the market has shifted from if to how high. A survey of retail investors shows that 57% now expect silver to smash through the $100 barrier in 2026 as they bet against the stability of the fiat dollar. But the veterans, the people who track the structural deficits, are looking at targets that the mainstream media previously considered insane. Analysts at firms like Sprott are citing the physical shortages in China and targeting a move toward $100 per ounce. Goldman Sachs has moved its base target into the $85 to $100 range, explicitly labeling silver as the indispensable strategic metal for both AI and the green transition. We are looking at an RSI of 93.86, the highest since 1980. In any other market, this would signal a crash. But in a market where the CME is hiking margins to $25,000 to stop Silver Thursday, and the COMEX inventories are down 70%, technical indicators are secondary to physical reality. The system has reached a limit. The arbitrage is becoming impossible. And the countdown to the January 1st export ban has entered its final 72 hours. If you haven't already, you need to ask yourself, do I have enough physical protection for what is coming in 2026? The question is no longer what is the price. The question is there any metal left? If you found this breakdown of the December 28th analysis valuable, make sure you like the video and share it with someone who is still holding paper promises. I'm Kevin Huang, and this is Markets in Context. Subscribe now to stay on the front lines of this global squeeze. We will be watching the opening bells in Asia very closely tomorrow morning. If the Shanghai premium holds, the $80 floor is confirmed, and the race to 100 is on. Hold your physical, protect your family. I'll see you in the next update.